About a quarter of the world's maritime oil trade used to pass through the Strait of Hormuz. That all changed in February with the start of the Iran war. Now, we're dealing with price hikes and an uncertain future. Rory Johnston is an oil market researcher and founder of the Commodity Context newsletter, and he joins us in studio. How are you doing, Rory?
Thanks for having me.
All right. Before last weekend, there were allegedly peace talks between Iran and the U.S. This week, there were more attacks. How difficult is it to really know what's happening in the Strait of Hormuz?
So in terms of the negotiation status, it's extremely hard to keep track of. There are a bunch of different variables and factors in these negotiations between Washington and Tehran. And it's kind of like a bouncing ball as to which one is front and center at the moment between a complete cessation of hostilities, including Lebanon and Israel, which has been a big sticking point, the status of nuclear talks and kind of where the position, whether or not they come first or later, and then, of course, the status of the Strait of Hormuz and Iran's ongoing control of it.
I jokingly said this to you, but, you know, oil is what you do, but it does feel like you are a bit of a, you know, a reporter on foreign affairs.
Yeah, I would say, I mean, thankfully, my background is actually more on international relations, and I teach at the University of Toronto's Monk School. So thankfully, I feel like I'm well suited for this, but it has been much more geopolitics recently and much less of the normal market watching, because a lot of the data that we use in the market is actually lagged. And 2 months is like an eternity in this war, as we're clearly seeing.
All right, help us understand, how many ships are still trapped in the Strait right now? Do we know?
So depending on the count, you're looking at a couple hundred still trapped in the Strait, probably upwards of 1,000 if you include all ships. And in terms of the actual ships that are getting out or transiting the Strait right now, despite the fact that the IRGC, the Iranian Revolutionary Guard Corps, has been claiming on certain days upwards of 30 to 40 ships passing, the ships that we're watching, the big ships of consequence, tankers, cargo ships, et cetera, we're still only looking between 2 and 9 ships a day transiting the Strait versus pre-war levels of like 150.
Wow. Okay. Fair to say there doesn't seem to be an end in sight at the moment. And we know that nations with strategic petroleum reserves are drawing on them quite rapidly. But I do have to ask, why aren't we seeing oil prices higher than what we are seeing right now?
That's the question that's dominated my last couple of months, because I was certainly front and center talking about the potential that this could drive oil prices upwards of $200 a barrel. And here we are today sitting below $100 a barrel. So what's going on? I think there's a couple things. Firstly, and very importantly, relative to, say, 2022, the last time we had a big oil crisis when Russia invaded Ukraine, we started that year in 2022 with really, really low oil stocks and a really, really tight market. And that basically, Russia kind of pushed us into the danger zone. This, at the beginning of 2026, we had a very, very oversupplied oil market, and we had an oversupplied oil market for upwards of a full year prior to the start of the war. That allowed us to build up a lot of these inventories or stockpiles in the global system that have effectively acted as a buffer. And that, I think, has saved us from the worst of the consequences immediately, but those buffers are still finite by definition, and we're drawing them down now at a record pace.
So fair to say that if this continues to drag on, we could be in that conversation of $200 a barrel?
Yes, I would say if the Strait was to remain closed in perpetuity, let's say, just for scenario assessment here, that is the level, $200 or so a barrel, that would be required to destroy the level of demand required to balance the market without the Strait of Hormuz. I think at this stage, I think the hope is that we do not hit that point because we get some kind of negotiated settlement before that. But that is the upside of the ceiling, and that's the risk that we're facing and why President Trump in particular is keen to make a deal as quickly as possible.
All right. Since we're talking about demand, I want to get a better definition of demand destruction. I am someone who loves my car, but over the last couple of months, I've actually tinkered with transit, and I might be falling in love with it and being like, you know what? Maybe I leave the car back at home, and this is what I do. Help me understand how sort of the demand and supply chain kind of works when something like this happens with the Strait of Hormuz.
Yeah, so demand destruction is a word that we're seeing bandied around a lot right now. And I think, you know, as you note, it's not very tightly defined. So I think it's important here to talk about 3 different types of demand destruction. What you're talking about, prices are high, so you're considering transit or maybe taking a bike. I actually biked to the studio today.
Very good.
These are examples of price elastic demand destruction. So the price is too high, so I choose to substitute.
Okay.
There's also income elastic demand destruction, which is the price of oil is really high, it strains the global economy, the job I work at goes bankrupt, and I don't have a job to drive to, so I don't drive. That's income elastic demand destruction. The final piece here that's pretty important is government-mandated demand destruction. Think back to COVID, think back to those lockdowns. We've seen similar policies enacted across Asia where the epicenter of this supply loss has occurred to try and basically ration the available supply. But I think those are the three pieces. Right now, we're not really seeing much of the first two, which is what we'll need to see if prices, if this deficit continues into the market. And right now, we're still relying heavily on both kind of mandated demand or mobility declines and or the injection of huge volumes of strategic petroleum reserves into the market, which are all, again, finite.
All right, let's change gears a little bit. I want to talk a little bit about Canada. There are a number of oil and natural gas pipeline projects under consideration. What projects should Canada prioritize, and what incentives can the government offer to get them built?
Yeah, so I mostly focus on oil. So that's where my comments will focus. So not as much on the gas and LNG side, but on the oil side, there's really four options right now that people are discussing. You've got an expansion of the Trans Mountain system, about 360,000 barrels a day. Expansion of the mainline system, about 400,000. There's the Bridger expansion pipeline, or what they're now calling the Prairie Connect or Prairie Link pipeline, which is supposed to connect in with the old Keystone XL assets, the abandoned ones that, if you can remember those from a few years back. And then finally, there's this, I think, the main political pipeline in the country right now, which is this Northwest Coast oil pipeline that's being pushed by the Daniel Smith government in Alberta. Each of those have very different cost benefits to them. Importantly, the ones that head to the States are likely going to be the cheapest, and expansions are going to be cheaper than new pipelines. Because generally, you don't have to cross the Rockies, the environmental permitting is easier, you don't have First Nations concerns in the same way, although you still have some across the Midwest of the United States. But in general, it's always been cheaper to build southbound into the States, which is why 90+% of our oil has always gone there. But the challenge of that pipeline, and I think that's what the private sector would do if left to its own devices, because they have to prioritize the most profitable barrel and the most profitable route for their shareholders. The challenge is that further entrenches us into the monopsony, or essentially the overwhelming dependence on the U.S. market. It gives the U.S. refiners a lot of market power in pricing discussions. That's where we go to this Northwest Coast oil pipeline. It's going to be expensive, probably upwards of $30+ billion if we're using Trans Mountain as our comp. It's a bigger pipeline. It's going to be even less optimal route given the length. That's a very expensive pipeline, and it can't compete on a per barrel basis with those other southbound routes. But importantly, it provides a strategic optionality to access the Pacific Basin directly. And if it terminates in a deep water port, which is what people are hoping for, it allows us to have those big VLCC tankers that could service let's say, the India trade route.
What is VLC?
Yes, very large crude carrier. These are the largest category of tankers. And the challenge right now with the Trans Mountain system, and basically when you have a tanker that loads in Westridge and then exits at the Port of Vancouver, the Port of Vancouver is too small to facilitate these big tankers. That's limited our ability to trade with India, as an example. We tried at the very beginning. They did a bunch of ship-to-ship transfers. It was complicated. They didn't love it. We do trade with India, but out of the U.S. Gulf Coast. So we ship barrels all the way to Houston and then ship 1 to 2 of these VLCCs, the big tankers, 2 million barrels each, to India per month. But I think it's a strategic mandate, really, to be able to service that trade through Canadian sovereign ports and territory, because we've seen this time last year, we were in a trade war with the United States and they were threatening to put tariffs on our oil. That threat was most consequential because we didn't have anywhere else to put the oil. We had to take their market.
Okay, is there anything that the government can do in terms of incentives to get that built faster?
Yeah, I think that if that were to happen, and again, I was saying that I think that Northwest Coast oil pipeline is unlikely to be built without government support, probably both from the government in Edmonton and the Crown in Ottawa. Now, there's a bunch of ways that could look, whether or not that's direct funding for, say, pathways to shift some of the dollars elsewhere, or they've often talked, the various parties to the MOU have talked about Indigenous co-ownership guarantees. This is something that the government could put money into that would be a subsidy without being a subsidy, if you know what I mean.
Okay, very quickly, I do have to ask, you're a very busy person these days. Seems oil is all over the place. What keeps you up at night with this conflict?
What keeps me up at night, I think, is the fact that so far we have had this really sanguine market reaction to this shock. This is the big shock. This is the biggest shock in the history of the oil market, easily the biggest shock of my career, and prices are not yet factoring for that. I literally still to this day have people telling me, this proves that we never needed the Strait of Hormuz. And I think that is a catastrophically dangerous lesson to take from this. If the war was done today and we avoided the worst of it, I do fear that that gives, particularly Western policy leaders, an undue sense of security in the energy space. They're like, well, Hormuz didn't go wrong, so nothing can go wrong. And I think that is just when you tee yourself up for the next inevitable kind of crisis.
Very interesting stuff. Rory, thank you so much. Really appreciate it. Thank you so much for your insights.
Thanks for having me.